everyone. Welcome back. Today is me, Marcus Schaefer, Greenspring's Director of Growth, here with Pat Collins, our CEO. We're going to start today off with a quote and then quick discuss it. And that quote is, "If I have seen further, it is by standing on the shoulders of giants," by Sir Isaac Newton. One thing we do at Greenspring all the time is we're looking for the best research, the best ideas, the best people that have done this before. What lessons can we learn from? Today, we're going to talk about endowments. What lessons can we learn? What lessons can actually apply to the investors that we work with?
Thanks, Marcus. Yeah, it's always interesting looking at some of these endowments that are managing billions and billions of dollars, have employed some of the smartest people in the industry. So as you would expect, not only Greenspring, but many in the industry want to understand what they're doing, why they're doing it, how they're doing it. So I think we're going to dive into that. Hopefully we can talk about the lessons we've learned looking at endowments, and also maybe some things that you should be thinking about that maybe don't make sense for you as an investor that has different constraints and needs and whatnot than maybe an endowment for a university or a nonprofit or some other large organization. So looking forward to getting into the conversation.
Yeah, and endowments are really fascinating because one, it's like a biography. You never read a biography of somebody that's not famous, right? They only write biographies about famous people, and we only read biographies about famous people. So why are we looking at endowments? Well, it's because they're famous. It's because they've had awesome absolute performance. And as such, that kind of attracts a lot of people to understand, hey, what are they doing that's really, really interesting? I do think it's a little bit of a misnomer because endowments is an incredibly broad group of investors, and they're not all the same. So, Pat, maybe you can talk about some of the differences of endowments.
Yeah, we're lucky enough at Greenspring to work with many endowments, foundations. So I think you find some, and maybe the majority I've found that we work with tend to be set up to fund some kind of long-term goal operation of an organization. So it could be, if it's a university, maybe it's funding scholarships or funding a program at a university. If it's, at a larger, maybe nonprofit organization, it might just be, a lot of them are being used to supplement their operating expenses. The organization doesn't raise enough money to run their organization just from, maybe donations. So they need to have an influx of, cash flow from the endowment, and they set that up. And then others, you'll see even individual families that will put together foundations. Maybe they have a liquidity event, they sell a business, they have, a lot of wealth, and they decide they want to give back in a more perpetual, meaningful way, and they'll set up their own family foundation. Typically maybe going with the wishes of the family, not necessarily funding, an actual organization, if it will. So that might be whatever their particular charitable intent is. So I think there's a lot of different types of endowments and foundations that are out there. They tend to be others focused. I think that's the commonality, is that they're there to serve a greater purpose, hopefully to make the world a better place in some way. And they also have some other unique characteristics that we as individual investors don't really have. I think some of the ones that are really evident would be the fact that they don't pay taxes. That is a massive structural difference that they have. And that's actually, if you kind of read through some of the news out there, there's certainly politicians that don't like that aspect of certain foundations and endowments, and they want to try to change that. But for now, under our current tax code, they can invest in ways and not have to worry about tax ramifications. You and I and all of our clients that are individuals and families, we don't have that luxury. We have to think about after-tax returns. I think the other thing, just on foundations versus individuals, that we want to just keep in mind is that foundations, and we'll probably come back to this, but foundations have a perpetual time frame for the most part. So most of the time they say this thing should be lasting as long as the organization, and because maybe that organization hopefully has a long-term succession plan in it that's going to stay around for a long time, that you want that endowment to last forever. So whereas you and I, we have our families, and maybe we want to think about generational wealth if we have a lot of wealth. But for most people, they care about their own lifetimes. I want to make sure my money lasts as long as I do. And that's probably a factor in how they invest their assets. So I think it's important that we not look at foundations and endowments and say we want to replicate exactly what they're doing, because we're not like the foundation in several different ways that I just mentioned.
Yeah, it's great. I'll kind of summarize, purpose to serve others. They have this huge longevity aspect, right, where it tends to be perpetual in nature, but at the same time, they need cash flows today. Now, why is that interesting to study? It's interesting to study because you can make decisions differently knowing that you have this really long time horizon. Maybe, maybe not, because you kind of, for that to assume, you have to assume you have the same manager in there for that same time horizon, and managers turn over. So that's maybe not it. And the other thing I think is really, really interesting is the independent nature of these foundations and endowments, where it really is, hey, it's not an asset manager trying to sell you something. It's people out there trying to make really good decisions. And it's one of the few lenses we have where we can go out there and look and say, how are people assembling the best of what everybody else is producing? So I think that independent aspect is at least interesting for me. And as you mentioned, the needs of the endowments, the spending, there's a huge variation. So we tend to focus on kind of what I'll call elites and how the academic literature describes elites. You have your Ivy Leagues. They also sort by SAT scores and say, hey, give me the highest SAT scores, or size of foundation is another way. And that's what a lot of the focus from the media is on. But if you kind of go behind the scenes, we have data on another 750 foundations and endowments that aren't there. And then that's just people that want to willingly report. So there's this whole cross section of investors that have different spending needs and have different timelines. And so their portfolios are going to look different. So we talk in averages, but I think it really is important to recognize that everybody is unique. Every institution's unique. So we should expect their portfolios to be unique.
Yeah, I agree. I think in doing this research for this podcast, it's been interesting to dig in a little bit deeper into the numbers of what's happening in the endowment world, and to your point, there is some big differences. I think that was one of the things I took away, was that there is not a one size fits all, that there's obviously different sizes of endowments, there's different styles, they've approached it differently. And I think one of the things I'd love to dig into a little bit in this podcast is, what can we learn from these different foundations that we can take away as investors and implement in our portfolios, but then also just understanding maybe the differences on how they approach things and how there isn't a one size fits all. So maybe we could start by talking about what are some of the major things that we could learn that we learn from foundations and endowments, and what we think investors can learn from it. So any takeaways on your end that you think we should be starting with?
Yeah, I think for me, there was two major takeaways. There's process and there's performance. And when you get into finance, everybody wants to talk about performance. But what's fascinating is the more you get into it, the more you learn it's all about process. The more you think, hey, this is a really cool thing that somebody's doing to invest. It's pretty legal. It's pretty technical. It's not, hey, I have this great idea, let me go invest in it. So for me, what was fascinating more so was, hey, what can we learn from the process of these endowments? What can we learn from the successful one? How do they go about managing portfolios on a day-to-day basis? And then what are some of the lessons we can learn from performance? And really it's, what can we do? And what, as you mentioned earlier, is just unique to them, that the world's not fair. We don't all have the same advantages, and it's okay. So maybe we could start with process, just because I think that's actually the more relatable, even though it's probably not as much fun to talk about.
Yeah, the governance of an endowment or foundation is really interesting, and I agree with you that is probably the biggest takeaway for individual investors, is how can you take some of the governance and structure that they put in place and process they put in place and bring it down to your portfolio. I think this is something we talk about all the time at Greenspring in our investment committee and how we manage portfolios. But I think, it's interesting that we're having this podcast today. I had 2 meetings yesterday where I was able to sit in on 2 of our foundation institutional clients' investment committees. And that's typically how these endowments and foundations work, is there's a committee that is in charge of making decisions on behalf of the overall endowment. And I think it was a case where process saved them to a degree. In both cases, both endowment committees were really talking quite a bit about interest rates in this example of They saw interest rates, they thought they were going to rise. They said maybe we should reposition our bond portfolio in light of that. And we were able to take them back to kind of our governance and our process, which we have an investment policy statement, which is a standard document that most of these organizations develop that helps them make decisions on things like when to rebalance, when to allocate, how to allocate assets, how do you hire and fire managers, when do you make changes, things like that. And in both cases, we were able to kind of say, is this in line with our investment policy statement? And it wasn't. And so we'd have to have changed that document, changed our governance. And I think they came back and realized, this maybe isn't the right time to do this or the right way to do this. And I think what it came down to was they were, and I think this is where regular investors have to be careful. They were making decisions based on a prediction of the future. And that is really, we've talked about that in prior podcasts, how hard that is. That's why to have this governance and process in place to try to stop you or curb decision-making that maybe is bad decision-making. And I think that really is what the purpose of it is to help you make better decisions if you have good governance and good process in place. So, I talked to, when we were talking to these committees, I said to them, I don't know what the future is going to look like. I don't know what the next 6 months of interest rates are going to look like. None of us do. And so we need to make a good decision for the endowment today based on the information that we have. And I think we have put a lot of thought and effort into our process. We should follow that. Unless something has changed with our overall cash needs, cash flow in and out of the endowment, and there hadn't been. It was in 100% a prediction of what was going to happen. So, it comes back to, again, something we talked about in a prior podcast of decisions and results. And I think good process will lead to good decisions. Good decisions don't always equal good outcomes, though. That's the challenge. Because we deal in such uncertainty and such, to a degree, randomness in the short term, we don't know what the outcomes are always going to be. But again, if we make good decisions by having good process, and we do that over and over and over again, the averages start to work in our favor, and we're going to have good outcomes over time. But if you just look at one thing in isolation, it's really tough to say a good decision will lead to a good outcome in every single circumstance.
Yeah, it's a fantastic example of separation of powers in action. Right? Your main focus should be on how can we think about our spending plan? How can we think about this investment policy statement? And our main focus should be on, hey, how do we manage this with the highest likelihood of success? And that separation of power, sometimes that breaking of the emotional aspects, can be super, super beneficial because you allow and enable the best idea to come forwards. It's, if you look at the U.S. government, it's a great example. We have separation of powers. We have checks and balances. Those things create something that can last for a really, really long time. So by having that embedded in how you manage your finances, whether it's an institution or an individual, that should enable a longer term vision. And I think you kind of outlined hey, what are some of these different responsibilities, and I just alluded to it. One of the major responsibilities of the actual board, university board, endowment board, foundation board, that's really thinking about an effective spending policy that can last over time. And maybe just talk a little bit about what spending policies are.
Yeah, almost every foundation and endowment typically have something written about the spending, how they're going to spend money. And I think because of their perpetual nature, you have to think long and hard about spending because, if you overspend out of a portfolio, you run the risk of depleting that asset over time and no longer make it perpetual. I think that's a really important aspect. We see lots of different strategies around spending with policies. Typically, it's a percentage of the portfolio. It could be a set dollar amount. Oftentimes, you'll see things like, we'll take maybe the last 3 years average balance and then take a percentage of that to smooth it to some degree. But I think the point is that there is a spending policy, meaning a plan. They don't come in and say, let's spend this much this year, and then let's spend some other amount next year. We need more money. Let's just spend it. Oh, we had a good year. Let's take all the profits out of it. They have governance and process around how they're going to spend money. And I think as investors, we can take a lot away from that. We do have differences. We talked about this in the beginning. They want to stay perpetual. We have a finite kind of time frame on how long we need to spend money out of a portfolio. But there is still a lot of similarities in the sense that we want it to be sustainable. We don't want to run out of money at some point, so we have to have a plan in place. It was interesting reading through the latest research on these endowments from NACUBO. Do you know what NACUBO stands for? I don't recall.
National Association of College, Board, University Endowments. Some accumulation of those words.
Great. So I think they probably have the most exhaustive, it seems like, study on things like asset allocation, spending policies. And I know it's self-reporting. These organizations will report back to them on these. But it's telling. And one of the things that they showed in that study was that last year, the average percent of withdrawal from a portfolio from a percentage standpoint was 4.7%. The year before that, it was 4%. So if we take that, it's kind of a starting point. We know that endowments tend to be 4 to 5% of the value of that portfolio. But somewhere in that range, they're taking out each year. That's probably part of their spending policy. And it's not that dissimilar from investors. We have to think about things like how much can we take out of a portfolio to make sure it's sustainable. I think the one big difference that I see with spending policies with universities, other nonprofits, and individuals is oftentimes the spending policies at the organizational level and an endowment tend to be a percentage of the portfolio. So you'll start to see swings, decent amount in spending based on the value of the portfolio. So you go through a long stretch of maybe a down market, poor investment returns, you could see spending significantly curtailed inside of an endowment. So you could see spending down 20, 30%. Most individual investors, that's a challenging thing to tell a retiree, hey, we're going to have to cut your spending by 30% because the market is down. What we found is most investors want to have a little bit more safety in the spending amounts so that they don't have to reduce their lifestyle. And so that changes things like asset allocation, how you take risk in the portfolio versus maybe an endowment, how they would do it. Because I think there is just this real desire to not have significant spending cuts in retirement. Whereas I think an endowment smooths that out, and they can also kind of maybe have other funding sources to think through.
Yeah, I mean, that's one of the differences. If you kind of just think about one of the things we talked about earlier, accumulation, withdrawal, those are kind of distinct phases, whereas endowments are, hey, you also get donations, you do get revenue every single year, and then you also have expenses. And one of the things I found really interesting, you're right, 4 to 5% per year, like clockwork, 30 years going back, we can kind of see this. So there is a ton of consistency. And what's fascinating is I think that separation of powers is also really helpful, like what you're talking about. In the great financial crisis, we actually saw a lot of endowments increase their spending and try to smooth that out. And what that shows to me and what shows to the researchers is, hey, when you have this perpetual long-term nature, it's not saying, hey, overreact and harm this group of students adversely. It's, hey, we did have a bunch of really good years on the front end. We expect to have some good years on the back end. So it's also some of the power to be able to spend. And we see that sometimes with retirees too, where it's a little bit helpful to say, hey, you can actually spend more money. We've modeled it out. Here's our expectations of the future. And so that separation of powers, I think it's really helpful to have conviction in what is the right amount of spending policy, what is sustainable, so you don't have to take a step back.
Yeah, and that is a tough, I will tell you, having counseled clients, that's a tough conversation to have with clients. But I think one of the other things I'd love to dive into a little bit more on this NACUBO study is just the real variation in what endowments are doing. I think one of the things that we found was, and it's interesting in the study, they're going to look at things like asset allocation, but they're going to look at it by size of the fund. So, if you have a $25 million endowment, it looks a lot different according to the study on average, than say $1 billion or a $5 billion endowment. But anything that you took away from the asset allocation decisions when you looked at endowments and maybe how it relates to investors?
Yeah, I think some of the big takeaways from asset allocation is one, which you just alluded to, the variation. I mean, with any individual with any like kind of type of investment, take hedge funds. You're seeing 0 to 80% of a portfolio in hedge funds. Alternatives, 0 to 60%. What is an alternative, right? That's like a question. So you see this massive variation. I would say that generally what we see is there tends to be kind of this linear march up in size, but the things that the elite institutions are doing $1 billion and up tend to be much more of what you read about on the headlines, right? So it's, hey, they're invested in private equity, private credit, venture. That tends to increase a whole lot more. And I think what's like fascinating to think about for individuals is what type of hurdle do you really need to hit to be able to have access to some of these more esoteric type of investments.
Yeah, I think there's also a question of whether it's good, whether it actually adds tremendous amounts of value for both the endowments and for individual investors. So there's a couple things I wanted to touch on that. First off, that is only a 1-year study, but it was really interesting, like looking at the last year in Nakubo, the highest performers of the endowments were all of the smallest endowments. And why is that? Well, it's because they have a much larger allocation to public investments like stocks and bonds. And the largest endowments were the worst performers, and they have a much larger allocation to private investments. So it's not an automatic, if I invest in these complex private investments, I'm going to have better performance. So I think that's the first thing to understand. Not to say that, again, performance is not, especially 1-year performance, is not something that you should be really making any decisions around. But I do think it was just an interesting data point. The other, when we started to kind of dig into the numbers too, we found that these were just averages. And there are managers and there are endowments that do things vastly differently. I'd love to spend a few minutes talking about one of the managers we researched was the head of the Nevada State Pension Plan. And this would definitely be one of these managers that is in the very, very large kind of space. Their endowment or pension was $60 billion. Is just a gigantic number of how much they invest. And when we started to look into it, what we found was this would be somebody that would definitely be on the kind of eligibility for access to any types of private investments that he would think might be appropriate. But what we found was, first, what was really fascinating, he was for a long time, the only employee at the company. He was investing all $60 billion himself. Just recently, they hired a second employee. So you compare that to something like a Harvard or a Yale endowment, and there's dozens and dozens, if not hundreds, of people that are working at those organizations. So how is it that he could manage $60 billion on his own? And what you find out when you get into it is that he has basically, for about 90% of the portfolio, he has put it into index funds. And as I read his story, and he's had phenomenal performance. I think when he joined the fund, they had 15 billion of assets, and they're now over 60. And so one of the things that I took away just reminded me of a story or a movie that probably many of our listeners might have seen or read the book, is Moneyball. And if you think about the story of Moneyball, it is a story essentially about the Oakland A's and the GM of the Oakland A's baseball team that didn't have much money. They're in a small market. They had to compete with the Yankees and the Dodgers that all had all of this money. And what they were finding was the Yankees and the Dodgers and all the major organizations, they were making decisions based on, kind of the old way of doing things. This is the way it's always been done. This is how everybody else does it, so it must be right. This guy from the A's decided, what if we look at the data and the evidence? And what I kind of compare that to is this manager who said, if you read kind of what he says, is there's really just a couple things that matter a lot in our performance. One is our asset allocation. How do we allocate the assets between stocks, bonds, other types of investments? And then the second is fees. That matters a lot. Can we reduce the fees? Because every dollar we pay in fees is a less that's going to the retirees here. And so when I looked at the numbers at their level, they were paying for 90% of the portfolio, they were paying 1 basis point. That is 0.01%. It's almost not paying for the management of these assets. And you compare that to these large endowments that have gone heavily into hedge funds and privates and other types of investments like that. And they have, dozens and dozens of analysts that are doing manager due diligence and whatnot. And I wonder how much of it is these studies that we read, like Nakubo, that all these other managers are reading it too, and they say, "Oh, $1 billion? We have over $1 billion. It looks like the average manager here has X% in private investments. I guess we should too." And instead of kind of just following what everybody else does, I think there's an element that I think all of us can learn is let's first start with the data and the evidence and make sure the decisions that we're making are rooted in that evidence before we start making decisions just because everybody else is doing it. So that was one of the things I thought was really fascinating in some of the research we did.
Yeah, and it's, pick the game you want to play. If you want newspaper articles written about you, there's a way of investing that's going to get more eyeballs, that's going to get more newspaper articles written about you. If you're just doing it for your individual constituent, there's a host of different ways to accomplish that. When you look over, I was reading a study, it was about 20 years, and the average endowment performance, just a 60% S&P 500, 40% bonds, beat by 4 basis points, 0.04% per year. 60-40 is like one of the hallmark portfolios for most investors out there. And across the spectrum, the average is doing exactly that. It explains 94% of their performance. When you add international stocks in, it explains 99% of the performance. So this gets to your point. It's, hey, what really matters? What matters is the asset allocation. Can you stick with it? And then the secondary consideration is how are you going to go out there and implement these different ideas? And as we kind of get into this a little bit, it's this question of what's your game? How are you playing it? So if we go back to something we talked about before, there's kind of this framework, 3 sources of alpha, of outperformance, right? And I thought it would be really, really interesting to break down what are kind of these elite institutions doing? What's the fun stuff? What's the exciting stuff? Through these 3 different sources of alpha. So again, we have traditional, which is more informational alpha. I'm smarter than you. I'm better than you. We have 2, which is risk-based alpha. I can just take different risks than you can. And then 3, I'm just a different investor than you are, and I can do things that you can't do. You mentioned taxes. This is like a great one as an example. So let's go through that framework because I will point out, again, the reason why we're talking about them, the elite institutions tend to outperform that 60-40, the average, by 2 or 3% per year. So if you kind of think about what that means for this really long, hey, if your spending policy is 5% a year, somebody else can get another half of that. This is why we see investors kind of chasing because you start thinking about how that compounds. It's incredibly powerful. There's a lot of incentive in markets to beat the market, even just by a little bit, which is why we see so much people running and going into it.
Yeah, so thinking about those 3 sources of alpha, the traditional alpha, which I would kind of put in there, finding, most endowments are not managing the investments themselves. They're picking managers and whatnot. So how successful are they at finding managers that can outperform the market because of stock selection, market timing, things like that? I don't think we've seen, at least when we did our research, we didn't see any evidence that they're getting alpha from superior kind of stock selection, market timing, other types of trading type strategies. Would you agree with that?
Yeah, most of the outperformance seems to be from asset allocation decisions. And if you kind of think about the evidence why, if you look over a 20-year time period, something like 15% of bonds, actively managed bond portfolios for public markets, can beat a benchmark. 20-year period for stocks, it's about 20% of active managers have outperformed. That's not just the magnitude, right? Because the magnitude matters also. So it's why would we expect something so different in these really, really tough to compete asset classes? And here's a lesson that I think for individuals, you don't have to play that game. And a lot of endowments do play that game, and I think it hurts them. Something like 60 or 70% of their public stock and bond portfolios are invested actively. You don't have to do that. All the evidence is saying, hey, we cannot do this. Now, if you kind of think about, does somebody like Yale maybe have a different game that they could play? Well, who would potentially be the best managers for these asset classes? They would probably be people that went to these elite institutions that tend to have a disproportionate amount of the people in high finance. Yale is also a trophy asset class, right? So this gets into what's unique about Yale and these Ivy League schools that's not unique about us. They're not a commodity. They're something special. If you go to the next investor and say, hey, Yale invested with me, they're going to say, hey, I've read a lot about them. They're pretty smart. I would love to invest. And then here comes the carrot. Well, you get different terms, right? Yale can negotiate. They do things a little different. You get different terms.
So nobody's come to you and said, wow, it's a huge marketing asset for us to say that Marcus Schaefer is invested in our fund. That hasn't happened yet for you, huh?
It has not, but I have a brand to protect. I'm not sure I can be out there endorsing it.
Well, maybe, so if we know that kind of the traditional alpha is no different with an endowment as it is with an individual investor, that it's really difficult, the evidence is stacked against you. What I think what you'd mentioned was the asset allocation decisions where we see that they've made some headway in developing some of this alpha that they've been able to generate. So what are some of those decisions that you've seen with endowments from an asset allocation decision that has caused them to be able to maybe outperform? And I think probably it's also good for us to talk about the risk associated with those, whether the access and the implementation can even be done at the individual investor kind of level. So any thoughts there?
Yeah, it looks like I'm going to generalize, the major difference in asset allocation decision appears to be coming from alternatives. Now, alternatives mean a bunch of different things. In this case, I'll kind of say private equity as an example, and hedge funds also. And to your point, the question is really, is it luck? Is it skill? Or is this just a different type of risk? And when you really start to unpack all these different alternatives, some of the things that researchers have done is they've started to understand, is this, even though we call it something different, if we were to say it was a bond or say it was a stock, what would your stock percentage of the portfolio be? What's your equity-like risk? And this is where we really start to see those that are outperforming, they're actually taking a lot more equity-like risk. So a big portion of this is just taking risk in a slightly different way, all the way up to 85% equity type portfolios, which leads a lot of researchers to say, hey, I'm not sure we can compare you to a 60-40, right? We might have to compare you to an 85-15 because you're using leverage inside of the vehicles. So there's a big portion of it that looks to be taking a little bit more risk.
I think that's a really important aspect for individuals to understand, is that when you hear, oh, they've outperformed, you really have to make sure you understand the benchmark and you have to understand why they're outperforming. And so if they are outperforming mostly because they're taking a lot more risk, that is something really, to think through on whether you would want to take that kind of risk as an investor to try to get outperformance, because there's a downside to risk, which is volatility typically, and everybody loves risk when things are going up, but it manifests itself in some pretty tough times when things go bad. So I think that's a really important aspect. I think the other, when you invest in private investments as well, I think there can be an illusion of stability in the sense that when I, come in the morning and I look at my tickers and I, search what my, stock or ETFs have done over the course of the day, I get real-time updates. But if I own a private equity fund that has 20 different businesses they've invested in, I don't know what those businesses are worth today. I don't know if they signed a new contract yesterday or lost a big client. It doesn't immediately get reflected in their price. They don't have to report earnings like a public company does. I guess my point there is you just have very little kind of price discovery on what the value actually is. So it looks like it stays pretty flat for the most part. But if you were to have to go buy or sell that stock or that company in the open market on any given day, there'd be widely different prices. So there's this illusion that these private investments are stable. And I think that's just something for us to keep in mind, is that they're just priced so differently. It's really hard to compare them to a public equity.
Yeah, and the data is getting a lot better, but the way I think about this is our houses, right? If these were publicly traded houses, and you could see it, people all the time were bidding on, hey, I want 1% of Pat's house, I want 1% of Marcus's house today, we would expect our value to fluctuate pretty dramatically. But when we think about what's my house worth, we have these anchors that we're kind of anchored to. And since we're not going to market and saying, how much would you pay for my house today? That's going to be a difference. So you're right. It's kind of, you do have to do these gymnastics. Risk is one of these things that's really, really difficult to measure. It's like, it's always there, but it's never there. You know, you only experience it once. And that's something with prices. You know, prices are kind of moving all the time, but you might not see them. And again, the data is getting a lot better. And the way that these bigger institutions invest, and I think this is what is really kind of one of these challenges for how much can these ideas be democratized down. The price fluctuation kind of matters a little bit less to them because they're mostly concerned about, hey, when you sell it, give me the cash back, right? Whereas the way a lot of retail investors, individual investors are, let me check my account balance every single day. But kind of this concept of the democratization of alternative investments is something you were alluding to, where you're saying, hey, all these endowments are, here's what the top performers are doing, so let me think about how I can do that too. And I think one of the major challenges, their size, some of the unique characteristics, I would call this financial intermediacy alpha, they can just command differences and they can access things like, if you have over $1 billion, you can kind of build a broadly diversified private investment pool. The minimums tend to be pretty high just per investment. But if you have a lot of money, you can start to get the average, which is just really, really hard to do in privates. And so the dispersion of returns, you might get this great outcome, but there's also the same chance you can get a really terrible outcome. You can kind of get more towards the average, which is an advantage of the larger institutions.
Yeah, we've thought about this a lot here at Greenspring for our clients, always looking for, how can we make improvements to portfolios? And obviously we would like to see what endowments are doing and whatnot. And I would say the vast majority, for some of the reasons you just mentioned, also some of the reasons I'm sure we've talked about earlier around taxes and whatnot, access, have kind of caused us to stay away from some of the private investments that have been marketed, I guess, to retail or individual investors. But I think there's a lens that we tend to think through adding asset classes to portfolios that it would be maybe helpful to go through for investors to understand, how should I think about, well, if Harvard's doing it, is it good for me to do it? And so I think the way we think about it first and foremost is this investment, is the outperformance or the performance of this investment reliant on a manager or some level of skill for it to be successful? So you tend to see that with things like hedge funds, for example. So many hedge funds have strategies that are all about the idea of, I'm going to buy all the stuff that we think is going to do well in the future. We're going to sell or go short all the things that we think are going to do poorly. It is a really tough thing, but you tend to see that that's kind of, those types of strategies tend to be, very much based on the skill of the manager, the analysts that work at those funds. We just tend to stay away from those for a lot of reasons. One, I think, is the risk of the manager retiring or leaving or whatnot. The other is just the ability, if we believe that markets are fairly efficient, which we've talked about in prior episodes, what's the likelihood that that's going to be able to continue with a manager? How can we determine if it was just luck or skill that caused that outperformance? So I think that's important. I think the other part would be, is this just duplicating more parts of our portfolio in a different way? So if we already own the vast majority of public equities and we buy a manager that is maybe moving in and out of public equities at different times because they have a trading strategy, what it ends up happening is we just kind of overweight certain parts of the portfolio over time based on what they're buying. So for us, what we've tended to kind of focus on is this truly, is there kind of is this asset class that we're investing in, is there a reason why it should go up in value outside of the manager, whatnot, just overall, is there an economic kind of intuition on why this should perform and have a positive expected return? So there has to be kind of a good reason. You can make those examples, like stocks is a great example. There's a reason why stocks should go up in value. There's people are taking risks, companies are innovating, they're earning more earnings over time, their value should go up. Bonds have a reason why you should make money in bonds, which is they generate interest. You're giving your money to an organization or a government. They're promising to repay it with interest. Real estate is another one. There's a reason why real estate, you should make money in that over time. So we want to make sure that it's not, that there's a real reason why this should make money. The second part of that is we want to see, does it add value in portfolios? Is it kind of correlated to everything else? If we're just buying an asset that basically is going to track very similarly to the stock market, does it really add any value in the portfolio? Are we just adding complexity and costs? So those are some of the things that when you're looking at private investments, you're looking at other types of strategies, we think, is it reliant on manager skill? Is there a reason why it should go up? Does it add value because it has a return kind of stream that is different than the returns that maybe of other parts of the portfolio? And when you start putting it through that lens, and then probably the last thing is it implementable? Can you buy it in such a way that it's after fees and expenses and taxes, that there's still a positive expected return over other parts of the portfolio? And if it can get through that kind of screening, then it's something we'll consider. And I think investors, and quite frankly, even endowments, should have similar kind of lenses to think about these alternatives through. What you'll find is if you have kind of a philosophy on how you think about those things, you tend to kind of weed out a lot of investments that get brought to you.
Yeah, it's a great example. And then you go back to what's the evidence actually say? And it's, hey, most of the performance, the average performance is essentially a 60% stock portfolio, 40% bond portfolio. Like, you go through all this complexity just to kind of end up oftentimes at the exact same spot. And I think that there is just some value in the elegance of simplicity, and simple looking doesn't mean that it's simply done. It just means one thing. One of the really fascinating things about markets today is like you could see, hey, you see one ticker in your portfolio could have 2,500 US stocks in it. You could see another ticker. It could have 10,000 plus, 11,000 plus non-US stocks in it, all the way from the bottom of the market cap, so the bottom in value, really, really tiny companies all over the world, to the largest companies. That's complex, but the way we visualize it is simple. And, if you look at the performance of endowments, and you say, hey, if it's really tough to copy what the largest, the elite endowments are doing, what's the cheapest, most effective way for me to get the average? And it kind of goes back to something we talked about before, which is being an average investor for an above average length of time leads you to be one of the better investors. That's kind of the secret formula, is can you do this every single day, every single year, and maintain exposure? And if you can, there's a really, really high likelihood that you're going to be.
Yeah. And maybe the last source of alpha, we've touched on a lot of these, but I think there's maybe a little bit just to talk through, which is this kind of financial alpha, if you will, or structural almost alpha, where it's like as an endowment, you have some parts of your DNA, if you will, that allow you to outperform compared to maybe averages or retail or individual investors. We already talked about taxes. That's just a huge one. If I'm thinking about investing in an asset class, and let's just say I would expect the returns to be 10% a year, but those returns will be fully taxable to me. Well, as an investor, I'm in a higher tax bracket. I might only get a 5% net return after tax, whereas that endowment's going to get the full 10% return. A major difference in how you select investments for an endowment versus an individual investor. You just have to be mindful of the tax piece. Maybe, do you want to talk a little bit about endowments and some of the other aspects that they can do, especially regarding leverage and other things like that, that might be just something that is more challenging for an individual investor?
Yeah, I think, again, I view them as trophy asset classes, right, that have just these unique advantages. And some are because they're historically well known as investors, and some are just in the way that they're set up. As these nonprofits, a lot of them can access municipal bond markets to help smooth their capital outflows out there. So a lot of them did this in 10, kind of the market continues where it's, hey, we want to build X instead of tapping our spending power. Let's go out there and get a municipal bond loan. And the advantages are like the inverse. You and I, we kind of just did something like this for a client. We said, hey, we need to go get some financing. We're going to go get, I'll generalize, the Fed risk-free rate. It's probably a 5 or a 10-year. And then we're going to pay 2.5% above that. They get the exact opposite. They give me 1% less than that number as my cost of financing. So it enables them, as you kind of think about their buckets between the board and the endowment, it gives them additional flexibility on really, really favorable terms to figure out, hey, in any given year, how can we help smooth our cash flow to best position ourselves? So that's, I think, one advantage in the way they implement that. And then again, as a trophy asset class, if you do find a manager and you say, I've determined that this manager is actually skilled, what that manager will do is they're going to increase their fees, right? Because they're the skillful manager, right? Hey, we're generating all these returns. You should be happy to pay us more fees. And by being some of these trophy asset classes, they can help negotiate against that. If those managers are within a broader organization and they want to go out on their own, hey, we would love to be a seed investor. So there's just a bunch of, there's some of the most famous investors out there. And when you're a really, really famous investor, you have this power and this willingness. And again, if your portfolio is 50 billion, you're willing to contribute 50 million to meet these minimums, to be a large anchor, 100 million. If you only have even 50 million, but half of it's taxable or most of it's taxable, and these are really tax inefficient investments, you don't have kind of the same power. And I think that's just a fact of life. They have these advantages, and we have to think about what advantages do we have and play to those strengths instead.
And I think even we see it at Greenspring in a smaller scale. I mean, our firm manages approximately $8 billion or so of assets. And we have access, even for our clients, to investments that maybe have, in a few cases, I'm thinking of $15 million minimums where we can get our clients into those investments basically at any price, but we aggregate as a firm and those organizations allow it. Whereas if you're an individual investor, and you wanted access to some of these investments that we have, you'd have to, it's a $15 million minimum. And these are investments that we might only allocate 2 or 3 or 4% of a portfolio to. So you can do the math, and you'd have to have a lot of money to be able to access these things. So I do think that's a takeaway from the endowment model is, the size does give you access oftentimes to investments. Access isn't always good. Let's put it that way. I do want to stress that. It doesn't automatically mean, just because you have access, you're going to have higher returns. You have to understand what that underlying investment is. But it does provide you some opportunities that you probably would otherwise not have. So maybe we can, kind of wrap some of this stuff up. What are kind of the big conclusions that you think, based on what we talked about today, that individuals should take away from thinking about endowments, how they invest? What are the things that we really want people to understand and take away from that?
Yeah, I think kind of one of the first frameworks we introduced, which is process over performance. How can you design a process that enables you to be a really, really long-term investor? And endowments have kind of given us a roadmap. I mean, we have data on them going back 50 years to evaluate, hey, how has their spending changed over time in different various conditions? And I think it's a testament to a lot of these policy statements that we talked about earlier, which is if you design something, you put it in writing, and you have checks and balances and separations of power, you're going to be able to be a long-term investor. And that's kind of the unique trend, maybe not the name, is, hey, are you doing these process things? I think that's it. And then I loved your Moneyball example, which is figure out what game you're playing and go out there and play that game. And if you're not the New York Yankees, figure out what you can do successfully. And what we see from the average performance is a super low cost diversified portfolio can get you there. And there are some really big names that are doing it. It's just we don't talk about them because you can only write 1 or 2 articles before you're going to say the same thing in the 3rd or 4th article, right? So those are my big takeaways. What about you?
Yeah, I think you hit on the 2 big ones. I think the other ones that we talked about that I think is just really important for people to think through is maybe it goes back to process, but it's just a little bit more on the endowment side around these alternatives that they invest in. Have a lens that you send everything through when you're thinking about alternative investments, and make sure that there's a reason why there should be a positive expected return over stocks on, or bonds or whatever that is that you're looking at. Make sure that it's implementable after fees, taxes, all costs and expenses, and make sure it's not dependent on a manager to, their skill to be able to replicate it over time. So I think making sure if you're going to add asset classes to a portfolio, you have a process, you have a framework to send these things through before you make a decision. I think that's probably the big thing. And then the last thing would be just to keep in mind, these are endowments. They're not humans. They're not individuals. They have advantages that we don't. And we should keep that in mind as we invest, so we don't just go and say, what is Harvard doing? I'm just going to replicate that. So I think that's important. So I think the long and short takeaway, I think, is there's just so many great takeaways we can take away from endowments. There's also things that we have to be mindful of that we can't do as investors. And, both of those things are learning, experiences for us as investors. So those are kind of my big takeaways.
I love it. Yeah, it is pretty tough to replicate Harvard. That's why there's one of them, right?
That's right.
Thanks for the discussion today.